How do tax brackets work? Can an HSA hack make you a millionaire? And will buying real Christmas trees leave you broke? We're about to tell you. Welcome back to the Personal Finance Club show. Hey, Jen.
Hello, Jer. How are you?
Good. You were just on vacation in Mexico. I saw some tickety talks with Mom.
Yes, my mom's 65th birthday. We went to Mexico, to Cabo. We had a time at a
Oh,
little resort. And I just wanted to talk about my little time with the resort had like included things, right? So there was like a sister resort. So every night my mom and I went to these shows. And there was a Michael Jackson impersonator. He's from Ecuador, and he's the only Michael Jackson impersonator in Mexico, sorry, according to this resort. But
that's
what I
quite
loved
the
about this, first of all,
accomplishment.
show is amazing, mostly because Michael Jackson's music is amazing. But what I loved about this is that there was like standing room only. Like my mom and I had to wait 20 minutes just to sit down. Mind you, the night before was Chicago, we walked right in there. There was no way. There was plenty of seats left. Michael Jackson, that's how famous Michael Jackson is. That
Dang.
in Cabo, there was a impersonator from Ecuador, and there was standing room only for an impersonator. This man has been dead for like 20 years.
Yeah, exactly. 20 years after he died, still, yeah. Yeah, he was a different level. People talk about what were we talking about the other day? If like Taylor Swift was as big as Britney Spears, something like that, and I say yes, but
Yeah,
like I think like Michael Jackson and the Beatles probably
next
are a
level.
level that no one really has reached.
Yeah, my mom and I ended up watching like a YouTube of him in it was like Budapest or something, or like Bucharest or something like that, and people were just fainting. I think it's probably the video they circulate a lot. They were just
Right.
constantly fainting for the first two songs. They were just pulling people out of the audience that had fainted, and he didn't
That's
do
wild.
anything for a good like 90 seconds. He just stood there, like he turned his head once at like 60
That's
seconds in,
crazy.
but it was pretty bananas to watch. So like, and we had a time. That's the problem is like it wasn't even like we were just like, man, it's not Michael. It was like we still had a time because that's how iconic the songs are and like the
Yeah.
moves. So
And how many
um
fainted for the Ecuadorian impersonator?
I almost fainted because we had to wait 20 minutes to sit down. I was
just
like,
from just from
standing
fatigue.
room.
Okay.
I'm like,
Yeah.
I'm
Well,
on
maybe that's the
vacation.
problem.
But worth it. Loved it.
Nice. Well, I'm gonna make a note to track that guy down for my next Mexican
I followed him on
vacation.
Instagram. He only had like 1,000 followers. I was like,
Really?
it's different in Mexico.
That's awesome.
Okay, should we get into it?
Let's do it. Let's talk about personal finance.
Let's do it. Okay. Explain it like I'm 5. We are going to talk about tax brackets. I said, how do they work? But really, I guess the better question is like, why does it matter? Why do tax brackets matter?
Yes. Okay. So explain the U.S. tax code to a 5-year-old in approximately 3 minutes. No problem.
Setting you up for
Uh,
success, huh?
yeah. Tax brackets are a very integral concept to learn because I think a lot of people misunderstand them and then maybe make bad finance decisions. And so the core of this misunderstanding is when someone says, "Hey, I'm going to get a raise at work. I'm not even sure if it's worth it because it's going to push me into a new tax bracket and I'm going to take home less." And sometimes I hear people like say, "I'm actually have less I'm taking home less money because I'm in a higher tax bracket." And that's impossible. That never happens. And okay, in the last episode I promised, and I will continue this episode, I'm going to always make a metaphor that maybe a 5-year-old could
I'm
understand.
actually very excited.
And so imagine a set of stairs, like the staircase at your home if you live in 2-story home or just any set of staircase. And imagine you get paid in candy bars, like a big old Snickers or a Three
Mm.
Musketeers or a Milky
Mm-hmm.
Way or not a Twix. Twix comes in 2 packs, and that kind of gets a
Twix
little bit
catching strays. Okay.
well, it adds a level of complexity that we can't because
That's fair.
is it 1 Twix per step? Is it two? We need a
That's
single
fair.
bar. Butterfinger would be fine.
Ooh.
But it gets stuck in your teeth for me at least. Have you had the Butterfinger problem?
Yeah, I think we've all had that problem. I haven't
Okay.
even thought about a Butterfinger in probably 10 years because of that. I'm like, I don't
No.
want to lose a tooth.
I think my last Butterfinger was when I was like 11 years old. But
Yeah.
all right. Here we go. Okay. And there's also a candy bar eating monster who will take a bite. But the monster wants you to have some candy. So when you like do a little chore, you get a new candy bar and it's placed on the next step. So your first candy bar is on the first step, the second candy bar is on your second step, third on the third. And so let's say you do 3 chores
Mm-hmm.
and you get 3 candy bars on each of the steps, right?
Mm-hmm.
And so on the first step, the monster says, "Hey, I'm not going to take any bites of that one. That's your first one. You get to keep the whole thing." The second candy bar, the monster takes a little itty bitty 10% bite. Only 1/10 of it the monster takes. And the third step, they take like a 15% bite, and all the way up to like the 10th step. And the 10th step, they eat 37%. The monster eats 37% of the candy
Woo.
bar. And so if you do another chore, even though the monster's taking a bigger bite from the previous step, it doesn't mean that you end up with less candy. You still end up with more candy. And so if you do 10 chores and you get up to that 10th step, your last candy bar, instead of being the full candy bar, it'll only be the whatever it is, the 63% candy bar, because 37% is going to the monster, aka the federal income tax
Uncle
government.
Sam.
Yeah. But in the first candy bar, and so when people say, "Oh, I'm getting pushed a new tax bracket," that means you're like taking another step up, and your new income above all the previous steps is going to be taxed at a higher rate. But all those previous steps is still safe at their rates, and that's what marginal means. Marginal means only from that point forward is that new tax bracket in effect. And so when someone's saying, "Hey, I don't even want to do another chore. It's not worth it. I'm going to end up with less candy." No, that's not true. You're going to get more candy. You're just not going to get as much more as you would have gotten for your very first chore. And, I think philosophically, marginal tax brackets are a good thing, right? Because someone who's making $2 million a year and then makes another $100,000, and they go from 2 million to 2.1 million, that $100,000 isn't very meaningful to their ability to live a reasonably healthy life, right?
Right.
And so if that gets taxed at 37% or even 50% or even like in the 90% like it did back in like the 50s when marginal tax brackets were really high, like that person's still going to have their first $2 million that's safe. Whereas if it's your first $100,000 you're making, maybe 100,000 is too big. If it's your first $50,000 you're making, then you're going to kind of like need all that money. It's going to make a big impact. So I would prefer that first 100,000 taxed very, very low at like 0 or 5 or 10%. And that last 100,000, like over 2 million, taxed very, very high. That's the general concept. And, we could get into like all sorts of problems with the tax code, but that's marginal tax brackets. And so if someone ever tells you, "Hey, I'm getting pushed another tax bracket, it's not even worth it, I'm going to have less money," say that's not true, and tell them the story about the steps and the candy monster and how all your previous steps are safe because the candy monster only eats a certain amount of those, but the new candy is going to be taxed at a higher bracket. And so even though your top tax bracket might be 37%, your average candy bar is, when you average all those out, the 37% and the 0%, it might be like, 20% or something. So that's what a marginal tax bracket is.
Okay. I have some questions about this monster. I'm like, he's kind of like fair because he won't eat all your candy, but okay, like metaphors about the U.S.
I feel like
government.
a monster eating your candy is a very apt one for the federal government. It's like kind of chaotic. Don't really agree with all his decisions. Eating my candy at the end of the day.
Right.
But there's he's got a heart of gold. Maybe he's trying to do right at the end of the day. Hopefully.
He's got a heart of gold. I'm gonna leave that there. Let's move on to our next segment. Money, money. Can I ask a dumb one?
Yes, you can. Are you asking a dumb person? Are you asking a dumb question? We don't know. Let's find out.
Okay, let's find out. We had some questions, a couple of questions actually about HSA. We had an anonymous question that hopefully you'll just be able to kind of bring it all in together. This question's from Brooks. I don't know. Brooks could be any gender, but Brooks asks, "For the past decade, I have been making the max contribution to my HSA and using it to pay for medical expenses. In my family, our expenses meet our deductible most years. Last year, I heard from several people that I shouldn't use my HSA to pay for medical expenses. Instead, I should invest through my HSA and let that money grow triple taxed advantaged. What do you recommend? Paying for medical expenses now with untaxed dollars or using the HSA as an investment account with tax-free contributions, growth, and withdrawals?" Jeremy, talk to us.
I do think he made a little bit of an error there. He said pay for the medical expenses now with untaxed dollars. I think what he meant is taxed dollars. He's already paid income tax on that money. Then he would use that post-tax, already taxed money to pay for his HSA contributions. So a little bit of ground framework here. An HSA is a health savings account.
Right.
It's a bank account. And the intention of that bank account is instead of putting money into your checking account, which gets income tax when it comes out of your paycheck, you can put into an HSA, a health savings account. And then at tax time, you can say, hey, government, I put $5,000 into my HSA. Please don't tax me on that money. And then they
Mm-hmm.
won't. You'll get it. You'll get the refund, or it will have come out in the wash with your withholdings, whatever it is. And so he talked about the triple tax benefit. That's tax benefit number one. Any contributions into an HSA you don't pay income tax on. So if you
Mm-hmm.
make $50,000 a year and you put $5,000 into an HSA, you're only taxed as though you made $45,000 a year. That 5,000 goes straight in. Tax benefit number two is it grows tax free. And so if I put that $5,000 in and let it sit for, let's say, 14 years, in which case it has time to double twice, 5,000 becomes 10,000, 10,000 becomes 20,000. Now I have $20,000 in there from a 5,000 original amount, and that money is still untaxed. You don't pay tax on any of the growth or dividends you receive along the way. And then the third tax benefit is if I withdraw that money, if I write a check or use my debit card against that account and pay for a qualified medical expense, going to the doctor, the dentist, even things like sunscreen and preventative care, there's a long list of what counts, that isn't taxed. And it's like the best tax advantage account, better than a Roth IRA, better than a 401k, better than a TSP. It's better than all these because none of the other accounts have no tax on the way in and no tax on the way out.
Mm-hmm.
And so what Brooks's friends are telling him are saying, hey, by paying for your medical expenses in the first year, you're really only using one of those tax benefits. It's going in tax free, which is good, but then you're immediately taking out before any growth, and so the growth tax free doesn't matter, and then the withdrawal tax free doesn't matter because there is no growth to be taxed, or there's no growth to be taxed on in the withdrawal. And so they're saying, here's the strategy that they're suggesting. I'm gonna explain the strategy and how to do it, and then I'm gonna tell you if you should do it, which is his real question. And so
Mm-hmm.
here's the strategy. You max fund your HSA every year. So for 2026, the max contribution you can make as an individual is 4,400, or as a family is 8,750. So Brooks said he has a family. So the strategy is you max fund your HSA, you put in the 8,750. Then when medical expenses come up, you don't pay for them out of your HSA. Instead of grabbing the debit card for your HSA, you grab your regular old credit card or your regular old debit card. You pay for it out of your checking account with already taxed dollars.
Mm-hmm.
Then you keep all the receipts for those medical expenses. So let's say I go to the doctor, I get a $500 bill. I save that into a folder in my Google Drive with the date. It says, December 11th, 2025, doctor appointment. And then I create a spreadsheet and called HSA receipts. And I say, I log the date, the description, the amount, and then the refund status. And so I have a very careful record of every single time I've paid for medical expenses and whether or not I've reimbursed myself from the HSA.
Mm-hmm.
Then after you do all that, you wait many, many years. So you wait. So like, let's say you put in the $5,000, it grows to $20,000. Then in that 14 years later, you can then reimburse yourself. You can take the $500 that you spent on that medical expense out of the $20,000. And then you're
Mm-hmm.
left, instead of with 4,500 like you would be today, you're left with 19,500, right? Because that has had time to grow. And you can transfer all these receipts you now have careful IRS auditable records from over the years. The HSA has grown, 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 grown. You can pay for all that with future dollars in today's cost, right? So we know things cost more over time. So maybe the doctor appointment today is $500. Maybe in
Mm-hmm.
20 years it'll be $1,000, but you can pay for it with your grown money
Mm-hmm.
and only pay the $500.
Grown
Then,
money. Sorry.
with your own grown money. And then when the IRS comes and audits you and says, hey, you just withdrew $30,000 from your HSA all at once, prove to me those were for medical expenses. You said, hey, I'm reimbursing myself for the last 20 years of medical expenses. And then you can take your $30,000 and then go buy a boat with it or whatever, because you're doing it right. You did pay for it out of your checking account when it happened, and now you're just reimbursing yourself. You just happen to be reimbursing yourself years later. This, as far as I understand, is legal.
Illegal. I was about to ask.
Consult your CPA if you're concerned
Now,
about the legality things.
am I crazy, or are there HSAs that are use it or lose it?
You're not crazy. Well, I don't know if you're crazy, but this isn't the reason you're crazy. What you're thinking of is an FSA,
Okay.
the bane of my existence, because there's these two very similarly named accounts, HSA and FSA. HSA's health savings account, FSA's flexible savings account. And a flexible savings account is similar, but you have to spend it all by the end of the year. And my advice for an FSA is really simple. Never put $1 in there unless you're sure you're going to spend it. If you are, then do, because you get the tax break from putting it in. But if you put $5,000 into an FSA and you only spend $2,000, you lose that money, which is like mind-blowingly crazy to me.
Yeah. Okay. Gotcha.
So anyway, that's the strategy, which is don't actually spend money out of your HSA now. Wait until retirement or when you want to buy a house or years and years later. That way you get that triple tax benefit, not just the one tax benefit. What's my takeaway? This kind
Yes.
of falls into, like, you got to do a lot of things right to make this work. You have to keep very careful records.
Uh-huh.
You have to, make sure that this is like defensible to the IRS in case you're audited. And you have to be paying for money. You have to be paying with money out of your checking account now. I kind of like the idea that I can go to the doctor and not feel like it's hitting me right in the pocketbook and say, okay, that is what this money is there for. And I'm already getting this great tax benefit. I'm not paying income tax on this money, and I'm not paying tax on taking it out. And so the way I operate my HSA is I keep about $1,000 to $2,000 in cash in there, and the
Uh-huh.
rest from over the years I let grow. Brooks said that he basically spends it all every year, which is fine.
Uh-huh.
And for him, I might just keep doing that. But if you like what I said, you like that strategy, you think that it's going to result in more money down the road, go for it. But I think this might be one of those things where people get so caught up in the nuance that they're like, is it really even worth the effort if you make a mistake or if it just
Right.
adds like stress to your life? Because I think 30 years down the road, are you going to really have so much more money that's going to really make a meaningful amount of difference to your life? Maybe, maybe not. But I don't. I pay for things out of my HSA as they come up and then let the rest grow for some future date.
Okay, WWJD. What would Jeremy do? Got it.
Oh my gosh. I think that acronym has been taken by some other
My mom
slightly
said it
more
to me the
famous
other day.
J.
I was
He's up
like,
there
what?
with MJ and the Beatles.
Okay. All right, Brooks, thanks for writing in. Hope that answered your question. Let's move on to our next segment. Scroll Patrol. Jeremy has not seen this video. I got it from the internet. This is a quick one. So, Jeremy, click on that link, watch that video. Let us know what you think.
All right.
I'm not buying that. That's way too expensive. I don't even need that, actually. I wouldn't even buy that normally. Oh, hold on. Hold on now. That's a good deal. That's a real good deal. I don't know about that shipping though. Put 2 of those in my cart. Put 2 of those in my cart right now.
That's funny. I like that. So yeah, if you're just listening and not watching, that probably didn't make a whole lot of sense to you. But basically, it was a whiteboard that said Black Friday on it, and then there's a price of $299, and he said $299. He said that's too expensive, and then they wrote $600 above and crossed it out, and then he said, ooh, that's a good price. And then they wrote $51 shipping. He's like, oh, that's too expensive. And then he crossed that out and said free shipping. He said, oh, that's a great price. And so of course, it's a funny video. I really like it. It's really well executed. I think it's true because I think a lot of companies do this, but I think it speaks to a concept in personal finance called anchoring, which is $299 by itself seems like a lot of money, but when you compare it to $600, it seems very cheap. And so a lot of times, what companies will do, and like no one's more guilty of this than like social media influencers, like selling courses, like we are somewhat guilty of, but we don't really do this that bad. But we
No.
do it a little bit. But sometimes influencers they'll be like, "This course is a $25,000 course." No, but now it's only 1,000. You're like, "Wow, 1,000." I'm like, "Wait a minute, it's not a $25,000 course. You just made up that number."
Right.
But when you think about $25,000, you think about a year of spending at a university or the a raise you might get. You're like thinking like these really big terms, and then $1,000 seems small. But if you're like, oh, you can find all this information in a book for $12 from Amazon or from 36 cents in late fees from the library, or you can watch this guy read it to you for a $1,000 course, you'd be like, that is outrageously expensive. And so
Yeah.
he's like really demonstrating the real true human um, response to price anchoring, which
Mm-hmm.
companies use all the time to justify their pricing. And there's another video I saw this Black Friday where someone was in Home Depot and there's all these like Black Friday sales, like big price tag, like they're kind of like
Yeah.
the size of a sheet of paper, and he like lifting them up, and underneath the Black Friday price was the regular price, which was the exact same price.
Uh-huh.
And I'm sure that wasn't all of them. I'm sure there were some that were cheaper and some that was the same or whatever. But it certainly makes for like a very poignant video where you're like, okay, like these are just fake sales. And so
Yep.
I think as a consumer, you just have to be aware of that and say, hey, like I say, you can get 100% off anything you don't buy. Just don't buy it. You save 100%.
Say
That's
that
yeah,
again.
that's
Yeah.
like that's a real Black Friday sale. Is just don't buy it. And if you do buy it, do a little bit of research. There's a great site called camel.com where you can paste an Amazon link and it'll show you the price history. And sometimes I'm like, oh, okay, actually, legitimately, this is as cheap as it ever gets. But almost all the time, the price is just kind of like a little bouncy, like up and down, and it's
Right.
somewhere. Maybe it's at the top, maybe it's at the bottom, but it's not like this is some companies want you to believe that there's like some very timely pressure. Like it's usually super expensive, it's very cheap, but only for a moment. But usually that's not true. Usually the price is about the price any time of year, or there's many, many sales throughout the year where that would become the price. So I like this
Yep.
video.
Yeah, I mean, if all goes well, this episode will be coming out December 18th. So some of you last minute stragglers will be buying your Christmas gifts right now. Don't. Just first of all, just don't be. My family and I don't do gifts, which I
You
love.
said, are you a proponent of not buying any Christmas gifts?
We don't do gifts. It's so chill. We're all grown. Well, there's no babies, so like that makes it easier.
Oh my God, the
But
Grinch.
we're
No, I'm just
Grinches,
kidding.
and we just chill and eat. But anyway, I just think that you should not fall for the hype of like these huge, massive end of year Christmas sales because they're probably not actually deals.
100%. 100%. All right,
You're gonna
that
buy
gives
it,
a
just
grade.
buy it, but don't think you're getting some huge discount.
Yeah, and be aware. Yeah, be aware of it. And I think waiting to buy. A lot of times, if you wait to buy something, you realize you don't even need it at all. And so I think just delaying it by a month is, even if the sale goes away, is on average a good decision because maybe you wouldn't buy a few of those other things.
Period.
So at Sean.Hermes, I have never seen your content before that I'm aware of, but I give you an A+ because I have no critique of this. I thought it was really funny and it really illustrated the topic well.
Yeah, I thought he was that's you in an alternate universe. Like you would make a video like that for sure.
I just do the same thing in like blue infographic format. He's like,
No. Okay, cool. Last segment of the episode. Money. Jeremy had time today. As I mentioned, it is the holiday time. So you just posted your post, real versus fake tree. What are we seeing here on your Instagram post with these cute emojis?
all right, so Whitney on the left, she buys a real Christmas tree every year for $80, very reasonable, maybe even a good price for a Christmas tree. Wendy on the right buys a fake Christmas tree for $250, but she reuses it every year, and then she invests that extra $80 every year in an index fund. Fast forward 50 years of Christmases later, Whitney has 50 dead trees, and Wendy has $126,000.
Speaking
I have
of
a confession
Grinch.
about this. Yeah.
Yes.
Well, so I did not make this post. Back in the day when Vivi and Shane were still working for PFC, now they're working on
that's why
Nectarine
you
full
put
time.
it in the group chat.
Yeah. So Vivi and Shane made this post. To me, to my eye, I'm like kind of a robotic, like borderline autistic. I just think this is the exact same post we've made every single time, which is like spend less money, invest, you end up with more money. It's like the simplest topic. But this post is like insanely popular. The first time we reposted it like for a few Christmases now, and the first time we posted it was like the most popular post of the year. And like I don't like, all credit to Vivi and Shane, like they made it. I don't get it. Like it's not an extraordinary amount of money, but I think my guess at why it's so popular is that people.
They got emotional.
Exactly. It's like, how dare you? And
Yeah,
I don't even know what
that's
they're
really.
saying.
I didn't even know which comment to pick. I was like, they're heated.
I don't even know. And actually, someone was like up in my DMs about this comment too, and they're like, you're destroying the livelihood of families, and or like the hard-earned gains of families. And I was like,
oh no,
I literally don't even know what you're talking about. I'm talking about buying like and then she's like, Christmas tree farmers work really hard to build other Christmas trees. I was like, okay.
People don't play about Christmas. You had a whole bunch of Mariah Careys in your comment section.
Totally. And no disrespect to Christmas tree farmers, by the way. Like I'm sure they're really great people, but like you could literally make that argument about any frugality, like don't buy TV. Those TV employees work for whatever, Christmas tree farmers I think are a little bit more tangible because they're real people cutting down trees. But anytime you're not spending money, there's someone selling the thing who whose business is going to be hurt by it. So it felt like an attack on small business, that person, and I didn't mean for it to be. Anyway, what'd the commenters say?
Yeah, I had a hard time picking which comment because some people were lighthearted about it, but some people were really like, Grinch, like you stole Christmas. This commenter, they wasn't such a hot take. They said, I used a fake $30 garland for 2 years, 2 months total of that time. It's very squished and ugly, only enough to cover one bookshelf. Just bought real bows for $40. It'll only last 1 month, but it covers 2 shelves, fireplace, window, and 2 dresser tops. It's gorgeous, smells good, and I don't need a giant tub to store it in an attic. I have reached my savings goals, and this was one of those annual splurges that I hope to continue because it brings me joy. Or I don't know the gender, but they really got after you because they were just like, why would you take my joy? It's Christmas.
I think we could go out on a limb and say this was probably a female. I don't know. Maybe I'm painting with a broad brush, but I don't even know these words like garland and bows. I don't know what that means, but it's B-O-U-G-H-S.
The smell of pine? Do you like the smell of pine?
Yeah, but I like the smell of pine when I'm out in the forest, killing something that used to be alive.
Okay.
No, I'm just kidding. I'm not
Jesus
a hunter.
Christ.
Hey, well, I'm not a vegetarian either, so I can't judge. But all right. So my answer to this commenter is 100% go for it. When I post, this versus that type post, I think a lot of people think that oh, I'm anti-Christmas. If you spend money, it's literally just a thought experiment. Being hey, here's one of a billion choices you make with money throughout the course of your life. Here's one of the impacts it'll have. And, even my friends are like, Jeremy, you're not going to like this. I bought a coffee or something. I'm like, I don't mean to be the joy stomper. I just want someone to be thoughtful about it. And this person is. Mm-hmm. She's reached her savings goals. Mm-hmm. It brings her joy. That is 100% winning with money. Bravo, clap, clap, clap. I don't know if my mic always picks up clapping. I think it
I can hear it, yeah.
Okay. You're doing it. And the goal with everything in our content is about living your best life, living a good life, being happy, maximizing the joy and generosity of your life, not being the richest cemetery in the graveyard, right? You don't want to be the dead guy that's covered in gold coins because that's not winning, that's losing. You didn't get to use it, right?
Scrooge McDuck,
and so, I have zero problem with this. We have a fake tree at home right now.
Mm-hmm. Got a fake tree as well.
I think it's more about dead pine needles and
right.
I'm
just lazy.
And things like that. Yeah, laziness. It's not like I'm really banking on my real tree savings to be my retirement or something like that. I just think it's a little bit more convenient. But I'm sure when our kids are of the most magical Christmas age, we'll probably get a real tree and enjoy the pine smell.
Wow, so you're a hypocrite. Yeah. You're not only the Grinch, you are a hypocrite. You stole Christmas.
Vivi and Shane made this. They're the hypocrites.
Wow.
Actually, they usually sign their name at the bottom, but I think I might have replaced their caption with my caption beside my name, so I might have stolen their work.
Plagiarism!
I know, I forgot that. Oopsies.
Crazy. Amazing. Okay, so do what you want. This is just one example. You can either buy a coffee every day or get a Christmas tree. No, I'm just kidding. That math's not mathing. Well, okay. Merry holidays, everybody. And hopefully this hit home and you don't think that Jeremy's the Grinch. That's all we have time for you today on today's episode of the Personal Finance Club show. Thank you for listening, and we'll see you again next week.
And don't forget to live by the 2 rules of Personal Finance Club. Rule number 1, live below your means. And rule number 2, invest early and often. See you next time.
The Personal Finance Club show is produced by Jeremy Schneider and Jen Mundia. Music by Esabalu and Homie. Send your questions to podcast@personalfinanceclub.com. The Personal Finance Club show is co-hosted by Jeremy Schneider, who is a co-owner of Nectarine, an SEC-registered investment advisor. The views expressed on this show are those of the hosts and guests and do not necessarily reflect the views of Nectarine. Please refer to hellonectarine.com for all relevant disclosures. This podcast is for informational and educational purposes only and should not be construed as personalized investment advice or a solicitation to buy or sell any security. Listeners should consult their own financial, legal, or tax professionals for advice specific to their situation.